what is the solution then if we want to not see this sort of dollar crisis, if we don't want to see the sort of crazy inflation into the next few years? What do we do?
Yeah, well, the Fed should not just taper QE, it should halt it right now, just stop doing it. Not just gradually reduce the amount of QE, that's adding gasoline to the fire. Maybe they're adding less gasoline, but you don't put out a fire by pouring less gasoline on it. You got to, stop that and put water on it. So the Fed has to go cold turkey. Just right now, no more QE. In fact, we need the reverse. We need quantitative tightening. The Federal Reserve needs to start selling treasuries and mortgage-backed securities. It has to let interest rates go up, and not just a little bit. They need to go up a lot. And of course, when that happens, the whole house of cards literally is going to come crashing down. The Fed has to let stocks crash. Let real estate crash. Let bonds crash. None of these guys have any integrity. They don't give a damn about the country. They just want to make sure that they don't get the blame for the collapse. So, as I said, we kicked the can down the road. Now, that doesn't mean we're going to get away with it, because ultimately, the price that we're going to pay for not doing the right thing is going to be enormous, because we are going to have a currency crisis. We may have hyperinflation. And all of that is much worse than just letting the markets reprice to a realistic level and letting investors lose money and forcing the government to cut spending. If we continue until we have, hyperinflation, we wipe out everybody, and the losses are going to be far more painful for a lot more people. But obviously the time will run out at some point if we don't do something. But there is no way to avoid hyperinflation without a lot of pain. Now, of course, hyperinflation will be even more pain, but we have to be willing to bite that bullet and do it to ourselves rather than waiting for the crisis to do it to us. I think if you were listening to my recent podcasts, I was just comparing the rhetoric or the propaganda that the Soviets used to rationalize shortages of goods in their country and the relative abundance in the US, because back in the 1950s or 1960s, the Soviets would see images of stores in America, supermarkets with all sorts of products on the shelves, but in the Soviet Union, the supermarkets, the shelves were empty. There was nothing there. But the people were being told that, the Soviet Union was, the workers' paradise, and America was where the evil capitalists exploited the workers. And so everybody in America was poor, and all the Soviets had so much more money. And so it was confusing for them when they saw all these products. And the way the Soviet Union spun that is they said, well, that's because Americans are so poor, they can't afford to buy anything. And so the products just sit unsold on the shelves. But in the Soviet Union, the workers have so much money, the minute products are on the shelves, they buy them right away, and then they would say, and the American problem is a very difficult problem because the Americans will never have enough money to buy those products. However, here in the Soviet Union, since we already have so much money, well, eventually there'll be products to buy, but, you've got all the money. And, of course, that all made sense until you really thought about it, because the hard part is producing the products. Anybody can print money, right? And that's what the Soviet Union did. They printed a lot of money, but there were shortages of everything because nobody made anything. And now the U.S. government is trying to tell Americans, oh, the reason prices are going up is because of supply shortages. It's not supply shortages, it's a surplus of money. You just can't print money and give it to people and expect there to be goods to buy. The goods have to be produced. Demand has to come from supply. If you just print money and create demand, you can't get supply. Demand can't create supply. Supply is what creates demand. Just because people want something doesn't mean it's going to magically appear. Stuff has to be produced before you can consume it.
Could you tell us what is stagflation, and are we experiencing or are we at risk of any sort of stagflation?
Yeah, we've already got it, I think. And of course, it's the worst case scenario. It's the Fed's worst nightmare. So they're never going to admit it. Yeah, and it's interesting too, because the reason we even call it stagflation is during the 1970s, we were faced with a situation where we had high unemployment and high inflation. And the economists of the day, Keynesian economists, thought this was impossible. They believed that the only way you would have high inflation is if you had a strong economy with low unemployment. It was thought that high unemployment in and of itself meant that you would have low inflation. There was a trade-off. They talked about the Phillips curve. And so this completely perplexed the Keynesian economists because they were confronted with something that their textbook said couldn't happen. And so then they came up with the name stagflation to describe this thing that they thought was impossible. Well, the reason they thought it was impossible was because they don't really understand economics. I mean, the whole school of thought is complete nonsense. I always say that Keynesianism to economics is like astrology to astronomy. I mean, maybe there's stars there and stuff, but it's got nothing to do with actual science. But, you know, historically, normally, it's weak economies that have rising prices. You know, strong economies have lower prices, falling prices. So we've got stagflation, but the reason it's a big problem is because the Keynesian toolbook is very simple. If the economy is weak, you print money to stimulate it, right? If the economy is strong, right, then you withdraw money from circulation. So, and they also do that through interest rates. So weak economy, recession, cut interest rates. Strong economy, inflation, raise interest rates, right? Well, what happens if you've got a weak economy and inflation at the same time? You can't cut and raise interest rates together. You can't have a loose money and a tight monetary policy simultaneously. So the Fed has got to pick its poison, right? Is it going to try to stimulate the economy, or is it going to try to fight inflation? Because it can't do both. And if it tries to stimulate the economy, the act of stimulating the economy will make the inflation problem even worse. So not only does it would the Fed ignore the inflation problem to try to stimulate the weak economy, but in doing, it would make the inflation problem even worse. So that's why it's the worst possible outcome for the Fed. It's the outcome that we have, and that's why they have to completely deny it exists.
So then how would you solve that? Because in the 70s, they had to really raise interest rates in the 80s to combat what we were seeing in the 70s.
Well, that's what Paul Volcker, the Fed ultimately decided in 1980 that it was going to fight inflation regardless of the impact it had on the economy and employment. So they took those type of decisive actions to fight inflation. That was their primary goal. Well, if the Fed were to do that, it would require a similar commitment to tight money. The problem is, when Volcker did it, the national debt was a small fraction of what it is today. Corporations and individuals had much less debt, and the nature of the debt was different. The US government's national debt was financed with 30-year bonds. Now it's financed with one-year T-bills. So when Volcker raised interest rates up to 20% in 1980, it only impacted the new borrowing. It had no effect on the national debt. But if we were to raise interest rates now substantially, even 5 or 10%, for 20, but the entire $30 trillion national debt would be impacted. In fact, I think $10 trillion of the debt matures in the next year. So all that low interest rate debt would have to roll over in this higher interest rate environment. Back in 1980, nobody had an adjustable rate mortgage. They didn't exist. Now you've got a lot of people that have adjustable rate mortgages. Look at the credit card debt that we have now that we didn't have then. I mean, everybody, corporations have a lot of short-term debt. Look how much money they've borrowed to buy back their stock in a low interest rate environment. Well, when we move into a high interest rate environment, this is going to be a disaster. So if the Fed were to do what Volcker did and just fight inflation, regardless of the impact on the economy, it would be a far deeper recession than we had in 1980, 82. In fact, it would be a depression. And the US government would be forced to cut spending massively. In fact, it would have to make deep cuts to Social Security and Medicare, and it may even have to default on the national debt, on the Treasury bonds. It would have to tell our creditors, look, we can't pay. We don't have the money, so we're going to have to renegotiate and have a restructuring of this debt because we can't make the payments at these higher interest rates.